What's up, guys? In today's video, I'll walk you through what a brokerage account is, why you need one, and things to be aware of when using one. A brokerage account is an account used to invest outside of your retirement account. You can buy stocks, bonds, mutual funds, ETFs inside this type of account, and this is the account that you need to buy these investments. You can't just go into your checking or savings account and buy these types of investments. You need one because it allows you for investing freedom. You can access your investments anytime. With retirement accounts, though, you can't technically access that money until you're 59 and a half. That could be 30 years from now, and things could come up between now and then that you might need some money for, outside of what you have set aside for your emergency fund. Or you might want to invest for a longer term project, like maybe you want to do something 10 years from now, like buy a second home or do something else, and maybe between now and then you just like to tuck some money aside for that, but have it grow for a big purchase later on. A lot of people think that once they max out their retirement accounts, that's kind of what they're allowed to invest in. But this type of account does let you invest above and beyond what you're doing inside your retirement account. So if you're already at the point where you're maxing out your 401k or your IRA, which yes, those are really high limits, but if you do get to that point, this allows you to tuck away even more money for retirement, or like I said, for shorter term projects and purchases. Even if you're not maxing out your retirement accounts, say you're contributing 10% of your income to retirement, but maybe you want to contribute 5% or 10% or whatever you can to shorter term projects that you might have in mind prior to retirement. You could pay penalties if you need to access that money prior to turning 59 and a half. So having a brokerage account does allow you some flexibility with your own assets and gives you access to them. Now, some things to be aware of are taxes. When you buy and sell something inside an IRA, you don't have to worry about the taxes because all of the taxes are dealt with when you pull your money out of the account, depending on the account type. If you need more information on 401ks and IRAs and Roths, take a look at this video because I do walk you through those. But with a brokerage account, you are responsible for the taxes. Whether you buy something today and sell it 5 months from now, or if you buy something now, sell it 2 years from now, you're gonna have to pay tax if there is a gain on the investment that you sold. There's two different types of taxes to be aware of: capital gain tax and income tax. If you buy and sell something within a 1-year time frame, you're gonna pay income tax on the gain that you see in that investment. If you wait and hold that for longer than a year, then you pay capital gain tax, which is a lower tax rate than income tax. For example, if you have a $100 gain on something that you bought and sold within a year, you're gonna pay income tax. If you're at the 30% tax bracket, then you're gonna pay $30 on that $100 profit. If you hold it for over a year, then you're gonna pay what's called capital gain tax. That could be between 0 and 20%. If, say, you fall at that 15% range, and I'll link the tax brackets below so you can see what those numbers are, but if you fall at that 15% range, then instead of paying $30 in tax, you'll now pay $15. So it could save you a good chunk of taxes to own your investments for at least a year, if you're factoring in the cost of tax when you do sell your investments at a gain. Another thing to be aware of with investing in a brokerage account is a short-term mentality when it comes to your investments. Because when you invest in something, you don't want to think of it as a short-term quick fix or a quick return, because a lot of things take time to grow. And if it's something that you buy into that you're expecting a quick large profit from, it's probably not really realistic, and you could actually end up with the reverse and have a large loss instead. That's what happens to a lot of people that are seeking really quick returns. They actually end up with a really quick loss because they get into something that's really risky. So try to avoid that short-term mentality. Even if you may want to use that money prior to retirement, still when you're making your investment decisions, try to use that longer-term approach when you are deciding what to actually invest in. And if you need help building a portfolio, take a look at this video because I do walk you through that. Let me know in the comments below if you have any questions. I'd love to be a resource for you. Don't forget to subscribe if you're new here, and I'll see you in the next one. Bye.